apologies again for being slightly late. It reminded me of the car journey that there was a hedge fund, Renaissance, which had one of the best track records ever, and it was all systematic, and they used to take huge amounts of data into their models, and one statistical anomaly they found was that the markets, when it was sunny, the markets tended to go up disproportionately to what it should have been. So no doubt they were all short the market today with the snow, but anyway, I will try and hurry through this because I realise I was slightly late. So I'll give my background and then discuss some of the perils and pitfalls of equity investing. At any time, please feel free to interject and raise your hand, shout out, ask a question if you disagree with anything or if you want anything else explained. So my background briefly: chartered accountant in the late 1990s, to show my age. There was probably the worst auditor on record, and left to join the financial industry, initially in early stage venture capital, and actually we'll look at the dot-com era very briefly, but I joined a company that raised £80 million, and this was back in 1999 at the height of the dot-com era, and they quickly burnt through most of that £80 million and had to make a provision in their accounts against 35 out of their 36 investments they'd made. So it shows you sort of the hysteria at the time. But then made the leap into the hedge fund world, and that's where I met Jacob, and I could bore everyone for months about hedge funds. Suffice to say, a hedge fund has carte blanche to pretty much invest in anything it wants, anything that they believe has potential to make a profit. And met about 2,000, interrogated 2,000 hedge fund managers, and realised there was probably an inverse correlation between how sleek they were and how polished they look and their performance. So I always wanted to get the unkempt and messy looking guys, but a lot of, I hope there's not many Americans in here, but very Americans all spoke very well and elaborate about their investment methodology and risk management and trading, but in practice probably 5% of the investment of the hedge fund managers were above average. So you think about the fees that they pay, 2% management fee, 20% performance fee, very hard to continuously outperform the markets. And a lot of the hedge funds that should have been short and making money when the markets go down typically were very long biased and would struggle in the markets. And those managers that had great performance one year would probably be some of the worst performing managers the following year. But I helped launch a long short hedge fund. We started with about $12 million, got up to about 50 million. It was pretty market neutral, and it was trading around earnings announcements. They would wait for an earnings announcement. If there was a gap up in price, we'd just trade that momentum for about 2 weeks. Left there, so I was in the hedge fund world for about 15 years, and realised that having met at least 2,000 hedge fund managers telling me what they do, could I trade? And so I went on a 4-month course at the London Academy of Trading. All my initial ideas about how I was going to trade, whether it was with Shell versus BP, all these different pairs trades, all went out of the window on day one. And I was never a big believer in charts, but there were certain patterns on the candlestick, the bar charts, that would repeat, and I would try and wait for, I was very patient, I would wait for some rapid movements, whether it's in the equity indices or the currencies, and then either try and trade that momentum or a retracement. And some friends and family gave me some money to invest, and in hindsight, what I should have realised is that the money they gave me, they'd written off on day one. But my risk management was very tight, and so I'm sending them an email saying, I had a good day today, I'm up 27 basis points and 0.27%, and they're thinking, well, what's Jason smoking? They wanted to be up 27% and then down 8, up 15. They wanted huge volatility because I was trading currencies. So that wasn't going to work, so I gave them most of their money back, and I still do a little bit of trading, so I've still got an interest in the markets, but that interest in the markets, allied to quite a deep personal professional network, tax, I was quite fairly interested in tax when I was an accountant, led me to becoming a financial advisor. So I set up Jason Shelley Wealth Management, but I'm an appointed representative of St James Place, which is the largest wealth manager in the UK. Now I've got about 100 clients, and the London Academy of Trading, I approached them and said, could I present to some of your traders on the trading floor? And they said, sure, you can do that to try and gain some new clients. They said also, could I develop 2 courses to complement their day trading courses? And I present a wealth management course and an equity investing course. And last time I was here, probably about 2 years ago, it was more on the equity investing through a wealth management prism. But I thought today I'd do something slightly different and look at the equity markets, look at why they go up, but look at some of the shocks and bubbles that have developed in the equity markets. So areas to be aware of when you're investing in the equity markets. So one of the first slides, first started putting these slides together about 5 years ago. One of the first slides was whether it's the FTSE, you can take any equity index. And what we'll see is, we're going to look at some of the drops in the market. One thing that's noticeable is it's an upward sloping gradient. And so the first question I actually asked myself, and I'm going to throw it out to you, is why is there this buoyancy to the equity market? Why in general do equities go up? So I came up with 5 reasons. Anyone want to venture a reason why they go up? We're all kind of used to, it's the equity market. They analyse about 7% a year on average the equity market, so you're looking at doubling your money every decade. But why is it they go up?
Supply and demand.
Yes, supply and demand. If you think about the listed markets, you've got a finite number of companies that are listed that you can buy into, but the supply is continuously expanding. And I know that from wealth management. There's new long-only managers, the new hedge fund managers that are coming into existence, raising money. There's individuals investing more into their pensions or into ISAs, bonds, and that money filters down into the equity market. And so you have greatest demand than supply, so that's going to lead to upward momentum. A couple other reasons. Zip through.
Inflation.
Inflation, companies with pricing power can pass on inflationary costs, and it's deemed to be a hedge against inflation because the margins can be sustained, profits can continue to go up if you can raise prices to beat inflation, so that leads to companies staying profitable.
More information, like people have access to a lot more information on companies and trading. Therefore, there's a lot more.
Yeah, which I suppose goes back to the demand being there. But the other, what?
Could also be speculation in some cases where
Well, speculation we'll see with the bubbles that have developed. But the other reasons I came up with were that it's like a Darwinian ecosystem. It is survival of the profitable, and it's therefore those companies that have been usurped over their technology will eventually lose market value, drop out of the listed markets and be replaced by companies that are generating profits. And so you have that natural churn, and so you've got technological innovation linked to that. You've seen the rise of the tech stocks over the past 2 decades, replacing some of the older companies, and therefore you've got new profits being generated. And the last one goes back to my accounting background, is that equity as a shareholder, you rank lowest in the capital structure of a company. And so the senior secured debt holders will get paid off in liquidation. Any residual value, once all the debt's been paid off, goes to the shareholders. And so you're taking the most risk. And because of that, you should be compensated, and typically you are, by about 7% per year. Those reasons. So on inflation, and what I tell clients is that they should be investing. A lot of money within ISA still sits in cash ISA, which makes no sense because the stock market outperforms cash, and it needs to, because you're taking that risk. You're taking market risk, and if you did nothing, the real value of, in this scenario, £10,000 drops by 34-35% over 20 years, and the actual 10,000 doesn't go down, but the purchasing power, what it can afford because of inflation. And this is just a similar graph saying that you should be invested because equity markets will outperform the cash. The effects of compounding, this is quite a radical example, and Einstein referred to compounding as the eighth wonder of the world, and it really is. And so if you're given a choice, you could have 1 pence at the start of a month, which doubles every day for 30 days, or I'll give you £50,000 a day. Which one would you take? So who would take the 1p doubling? So everyone else would take the 50,000. Well, those people taking the 1 pence would be much better off. So that shows you, I mean, it's compounding at 100%, but just by doubling from 1 pence, you get to 5.4 million. And we'll see the power of compounding. Actually, it's illustrated here. This is someone investing €5,000 a year starting age 25 compared to age 35. And it doesn't sound like much because that's only €50,000 difference. But making money on your capital, this shows the benefit of compounding. This is only a 5% growth per year, but that 10-year delay, the lump sum by age, was it 65, is 80% more if you start 10 years earlier, because you're the compounding, you're growing a larger pot of capital that's then compounding, and it shows you that. And it's a kind of, often people say to me, well, is it too late to invest? And it's not. The earlier that you can start to invest, the better. It'll give you some more chance to get a much higher pot at the end. Professionals, we can skip through this. I don't know who this guy is. I just Googled professional fund manager and he came up. Actually, I'm sure I've magnified what's on his screen. I think it's a shopping list. So I don't know who he is. But my whole point of my equity investing course is to try and narrow the gap between the likes of him and people who want to invest in the stock market, and to try and also understand and take their best practice and what works for them and try and apply that when we're investing into shares. And this emoji guide to investing, it's trying to, successful investor investing with a lot more equanimity, and so trying to avoid that roller coaster of emotion going from rosy, you've got your sunglasses on, you're a saint, you're ruling the world, you're spewing out dollars, and then suddenly the markets turn and you're starting to panic, feeling sick and ashamed, and then praying at the low point, and then suddenly the market turns again and it starts the cycle again. So if you can be a little bit more level-headed, it's giving you a chance to avoid some human biases, and part of one module of my equity investing course is because we are humans, and trying to overcome the inherent biases that we have as humans when investing in companies. So a quick question for you: a coffee and a biscuit cost £1.10 in total. Coffee costs £1 more than the biscuit. How much does the biscuit cost? What's your first sort of instinct? No one wants to say, but probably 10 pence is a natural reaction to that question. When you do the maths, you realise that it's 5 pence. And what's happening here is that you've got, apparently, as humans, we have a dual purpose thinking system. So that first one is the impulsive, emotional, acting without thinking, relying on past experience, and intuitively that question, it's tricky to suggest the answer is 10 pence. The second, more cognitive, deliberate thinking process, taking into a greater range of data rather than just our own experience. And so when investing into companies, there's nothing wrong with having a gut feel and an instinct about a company, but making sure that's reinforced with whatever level of fundamental analysis that you want to perform. So very quickly, the types of companies, and what I noticed is there's a lot of recurring themes about recurring attributes that would lead to professional fund managers liking a stock. So what do you think, what kind of attributes of a company or even a market would they seek before they, or what would lead them to be positive and bullish about a company?
Good cash flows.
Yeah, so cash flow generation, and being an accountant, I know that profits can be manipulated through different accounting standards, accounting policies, but very hard to manipulate cash. And so high free cash flow generation, and then yeah, so that's definitely an area of focus, probably one of the most critical ones. Any others?
Management.
Yeah, strength of management team. So how long they've been at a company, their where they were previously, their track record in turning around companies, generating profit.
The sector that they're moving into, like if it's a fast-moving sector, if it's not.
Yeah, so some sector analysis, room for expansion, either through product development or expanding geographically. A couple of others.
What's the need that they fill? Like what are they providing as a core business
Yeah,
strategy?
I mean, linked to that is this concept of an economic moat, so barrier to entry. So a lot of, say, a payroll company that's embedded in a customer's operations, very unlikely, or HR operations, very unlikely for that customer to use someone else. You see a lot of that with the mega caps, whether it's Apple, Amazon, Microsoft, huge levels of, say, for Microsoft, customer loyalty and that brand awareness gives them a huge competitive edge, plus all the cash generation that goes into the research and development for all the other projects that they're involved in that's helping support those valuations. And actually return on capital is linked to that. The average in the market's about 15%, but the likes of the Microsoft and Apples are generating return on capital around 30%. And all that really means is that they're generating, compared to say 15%, if their return on capital is double that, they're generating double the amount of profits given their asset base than other companies. So that's a huge market advantage that they have as well. Return on capital and economic moats, whether they've got high levels of debt, are they trying to push through expenses as an exceptional item, as a non-recurring item to try and trick shareholders who are trying to value the company, the trend lines of their revenues and profits. And are they, the management teams, mentioned management teams, are they shareholder friendly? So they paying out dividends or share buybacks, buying back the company shares? How are they using the company's capital? Are they trying to acquire other companies because of their ego, or are those companies going to be accretive to their earnings? A couple of quotes. First one, October, one of the truly dangerous months to speculate in stocks. Every other month is then mentioned. Who do we think that's attributable to? He's famous for a lot of quotes, and if you were paying attention briefly to the previous slide, you'd have seen them. Huckleberry Finn, anyone? Was that before your time? That's Mark Twain. You should read some of his books and some of his quotes. Be fearful when others are greedy, greedy when others are fearful. A famous quote from
Warren Buffett.
Yes, although it is attributable to Buffett, although I'm pretty certain I saw it about 50 years before Buffett from one of these other gentlemen, so I think he has unashamedly plagiarised that quote. I might sue him for it. Markets can remain irrational longer than you can remain solvent. Particularly the case during the dot-com era, where there were a lot of hedge funds trying to short the Nasdaq, but when it keeps going up and they realised it was so overvalued, there's only so much pain they could take. That was John Maynard Keynes, the economist. When it comes to investing, nothing will pay off more than educating yourself. It's quite self-serving of me to include that on my courses. That was Benjamin Franklin, one of the forefathers of the US Constitution. Successful investing is about managing risk, not avoiding it, and this is who Buffett plagiarised off, the father of value investing. Yeah, correct, Benjamin Graham, around the 1940s. And so Buffett, similar to Buffett, asked them what their favourite holding period is, and will say forever. So they really understand their companies and know trading around positions. You can't have some quotes without the future ain't what it used to be without Yogi Berra. He either played for or managed the Yankees and the Mets. And then just a few more from Mark Twain. And hopefully that one, it's better to keep your mouth closed and let people think you're a fool than to open it and remove all doubt. Hopefully that doesn't apply here. So you can see that graph, again that graph, the upward sloping equity index, and some of the exogenous shocks, and we'll look at some of these, that you think would and have impacted the markets, but the markets take those shocks in its stride, and whether it's invasion of Iraq, 9/11, some trade wars with China, financial crisis, war in Ukraine, pandemic. We'll look at some of these in more detail. But what this is showing, that stock market falls of more than 10% happen in, it was about 60% of the time you're going to have a calendar loss greater than 10%. And it's part of my role where my wealth management hat is to educate clients that they should expect, even in an up year, they should expect the markets to still have a drawdown of 10%. But and actually it's making sure they don't panic and taking money out of the market at the wrong time. And I think it's around 20% of the time you're going to have a fall of greater than 20%. But those returns after some of these crises that we'll look at are then very healthy, whether it's on a 1-year basis, 3-year, and what you tend to find is that you have a very extended bull market run that's punctured by a very sharp correction, bear market, and all that's doing is then precipitating another long bull market run. And so the returns, though, and they're great buying opportunities. These types of crises that we've seen, whether it's COVID, financial crisis, the dot-com bursting the dot-com bubble, every 10 to 12 years we're seeing markets go down 35–40%. And it's a tremendous reset, but a tremendous buying opportunity rather than panicking it. And stock market, this is the stock market recovering from 6 previous conflicts and wars, and again those wars really are marking a low point in the market and showing you the types of returns that can be generated thereafter. S&P's fallen 25% on 12 occasions going back to 1877, and those people trying to be clever and timing the market and moving into cash because they're unsure about the markets. Not sure about the last 2 because we've had rates going up, but potentially if you look at the drawdowns 2001, 2008 moving into cash, you'd still be loss making. You don't benefit from the subsequent rise in the markets. And part of that reason, as we'll see in a second, but this highlights the length of the bull market runs and then how sharp the corrections and how quick the corrections are. And typically the bear markets are around 20 months and the bull markets average about 7 years. And the bull market leading up to COVID was one of the longest bull markets in history. It was about 9–10 years without a 20% correction. So I argue even in the absence of COVID, something would have spooked the markets to lead to a correction. And that volatility, we tend to associate volatility as a negative, downside volatility. There's also upside volatility. And you can see here at the bottom, there's back in 2002 with the accounting scandals, bursting of the dot-com era, but it's the financial crisis. The heightened volatility tends to mark the bottom of the market, but what you're also seeing is that upside volatility coinciding with the downside volatility. And here, this chart highlights some of the 20 best and worst days. Some of those best days are following the day after the worst day. So during that worst day, if the market's off 7–8% and investors are panicking and thinking, I've got to move into cash, they're going to miss the 7% recovery the following day. And that's why it really making sure that you've got the capacity for loss, you've got the capacity to not need to access the capital that's invested in the stock market, because you'll just be taking it out at the wrong time. And staying invested, why it's so important, this is a 20-year time frame in the FTSE All Share Index, and over 20 years it returned 157%. If you miss just the best 10 days, that's just 10 days out of 20 years, that 157% return drops to 39%. You miss the best 20 days, you've now lost money. And those best days typically are straight after the worst days. And so the last thing you should be doing is trying to be clever and dipping in and out of the market. You need to stay invested. So we'll look at some of the bubbles. Who knows what the first financial bubble was?
Tulip.
Yes, tulips back in the mid-1600s. At the time, Amsterdam, one of the richest cities in Europe because of its international trade connections. And tulips were then imported, and so the Dutch hadn't seen that type of flower before, so it was seen as a status symbol. it was a very rudimentary derivatives market because the tulips only grew for, say, I don't know, 6 months of the year, but you could purchase in advance, like buy a forward contract for tulips for the rest of the year. And as we'll see some commonality between some of these bubbles, that as the prices kept going higher and higher, you then got the speculators thinking, well, this is easy money, I'll flip, I'll just buy, wait, the share price, the price of the tulip keeps going up, and I'll flip it and sell it, and then I'll use that money and repeat the same trade. And it works when the price keeps getting higher, but it's becoming artificially higher and higher. And what we see with a lot of these bubbles is in the preceding time frame, before the bursting or before the height of the price, you see a massive increase in value. So the tulip price index soaring from 1 guilder to 60. So that's tremendous growth and appreciation in only a 3-year time frame. So it's ripe then to be punctured severely. And especially when it's so overvalued. At the peak, a single bulb worth 10 times craftsman's annual income for one bulb. So it shows you how overpriced it became. There was a default on a contract by a buyer, and so it probably didn't need much as a catalyst for sellers to suddenly get concerned, and then that would start this sort of waterfall effect, and sellers then overwhelmed the market, and the price then gapping down as reality bites, and the bulb within days, suddenly the bulbs were worth 100th of their former price. The government tried to intervene. We've seen this before with other bubbles, government intervening and trying to honour contracts at 10% value, but actually that caused more panic and more shock in the market, and more selling pressure, and then the prices dropping back to where they were at a more rational, normalised market price. The South Sea, this is apparently Sir Isaac Newton investing at the right time originally, exiting very happy because he's made a lot of money. Then his friends are still invested, and he's seeing them getting richer and richer, and then he comes back in near the peak and then has to bail out at a certain point because he's suffering such a large loss. And apparently it was the equivalent of about £30 million in today's money. But anyway, South Sea Company was formed as a public-private partnership. It had a monopoly in that day and age to trade African slaves, predominantly to South America. The problem was that Spain controlled the seas around South America, and so none of these ships could actually get there. And so it was a lot of hype and misinformation to investors to invest into their company when they couldn't trade. They were allowed to purchase the national debt at a discount, and they would issue shares to pay the interest. And when the debt was trading below par, it would be consolidated at par. So there was a lot of inside information because the insiders knew when that consolidation was going to happen, so they were buying debt themselves knowing that it would be consolidated at par and they'd make money, and they were telling their friends and politicians and loaning money to friends and politicians to buy shares, and eventually when there was no trade, it was realised there was no trade and they couldn't pay for the interest on the debt. Company then dropped by 80% of its value. And then actually a bubble act, believe it or not, passed in 1720. It was forbidding a public company without royal charter to try and provide some oversight of the companies. Railways, you can see the right hand index is the valuation. You can also see, so from 1843 up to about 1846, how it increased in value from, well, it doubled in value over about 2-3 years. So there was a mania associated with building railways, and there were harvests that needed to be transported, there was strong economic growth. The railway index doubled over 3-year time frames, so we're seeing this commonality of an index, a valuation, rise rapidly over a very short period of time. Investors hoped that the valuations would continue, that the share price would continue to go up, that there would be continued increases in profitability. We've seen this with other bubbles, that there was widespread use of leverage, of trading on margin, borrowing money to invest into the railway index. The left-hand index is the media coverage. So we saw this with the dot-com era. So the number of dedicated railway newspapers went from 3 up to 20, and so enticing more and more people to invest into the railways. Problem was that you had failure of the potato crop, starvation, economic downturns, and all these railways being built were then calling on the investors for new capital, and the investors didn't have that capital. French Revolution didn't help, potential unrest in the UK, and then some doubts about the accounting practices of the railway companies. So that bubble quickly burst, and the prices dropping back or dropping below the price before the bubble started. 1929 Great Crash. This is a pretty scary chart. The Dow Jones. Roaring 20s, so the preceding era characterised by industrial expansion, record profit levels. We've seen this before, huge speculative share buying on margins of people investing without the means to invest. Dow Jones increased tenfold in the preceding 9 years, so on average it should double. It's now gone up tenfold. It's a huge run up in value of the Dow based on unrealistic future expectations. There was an overproduction in crops, steel, and iron, forcing companies now to dump profits, or dump their products at a loss. So that really was the catalyst behind the bursting of that bubble. 25% of the US workforce apparently lost their jobs. A Black Monday saw Dow lose 13%, followed the next day by a further 12%, and so then you can understand panic from investors and selling at any price and a huge downward pressure. Overall, the Dow Jones lost 89% of its value. And the uptick rule was introduced, you can't short unless the last price is upwards. Some of the exchanges suspended trading in prices, and Banking Act separated commercial and investment banking. Then that Great Depression lasted throughout the 1930s, businesses closing, banks failing, and it took until 1954 for the Dow to reach its previous peak, which you can understand because it had gone up tenfold in such a short space of time. It's a massive correction, and so it took decades to recover. Japanese asset price, economic bubble linked to real estate, and so the price of real estate increasing significantly, and a lot of companies owned real estate, and so the share price of those companies were increasing rapidly. Commercial land rising 300% in a 6-year time frame, residential land 180%, so that huge run up in value over a very short time frame. A lot of Japanese companies still have a lot of high percentage of cross ownerships, Japanese companies owning shares in each other. Apparently the ground beneath the Imperial Palace at one point was worth more than the entire state of California, and so it shows you how overvalued the price of land and therefore the stock market became. Nikkei hit a high in December 1989. We've seen this before. It had risen 224% in only 4 years. PE ratio at 60 times. So if an average PE is about 15 times, now trading at 60 times earnings. Nikkei quickly plunged by 2/3. By March, it lost 80% of its value. Government trying to intervene and sustain unprofitable businesses, and finally it took until February of this year for the Nikkei to recover that low, and that's incredible. You think from 1989, it shows you how overvalued it was. I don't have time to keep going. Dot-com era, and I remember it well because I was at this venture capital group, and it really was a time where the internet was new and people didn't know how that was going to affect companies, and you could read up on it, and really the company, if it was the amount of money it was going to spend and waste on advertising increased its value to investors and the multiples it could attract, and yet there's no real tangible benefit to just raising money to spend it on marketing. So no one quite knew how it would work. And I always use the same example. There was this business plan that I received from Oxbridge educated people selling luxury hamper online. I don't even know what goes into a luxury hamper. I don't even know what the market is, but their year 2, I think it was even projected profit rather than revenue, was £1 billion, just because they're going to sell it on the internet. And so it just shows you how incredulous it was. But those types of companies were raising money at the time, and we've seen that the Nasdaq in particular, that had a lot of these dot-com companies, rose 400% from 1995 to 1999. So you've got huge, unrealistic valuation expectations of future profits and cash flows, all because of this internet. You had companies that were loss-making, raising money from venture capital without ever being profitable. You had a lot of IPO activity, you had a lot of whispers at the time from people saying, oh, you've got to buy this hot stock and this other one, and a lot of people also trading on margin. And no wonder then that the FTSE dropped 10%, eventually falling 53% from its high. Didn't help that Japan entered a recession, the Fed started raising interest rates, and also then some of the accounting scandals from the early 2000s, eroding confidence in the actual financial statements and markets themselves. Tesla, which people will always have a view of Tesla, but electric car maker, battery storage, solar panels, including the S&P 500 in December 2020, at the time, its market value 10 times greater than Volkswagen. Volkswagen sells 20 times more cars, 7 times more sales, 5 times more profits, and yet Tesla's valued 10 times that valuation. Tesla was valued at something like, it was valued at more than the next 5 leading car manufacturers combined. And you think that is just so unrealistic and therefore ripe for a reversal, especially when Volkswagen is dedicating billions towards its own research and development. We've got Chinese competition against Tesla. And you can see the disparity in the sell-side investment banks not quite knowing themselves which they're going to be ultra bullish or bearish. They're all based on future promise, autonomous taxi networks, making cars more efficiently, so pricing them. But Tesla's always had a premium to the price, but at some stage, the only so many people that are going to want to buy the Tesla at a premium, and therefore the price has to be much more in line with its competition. Someone like Elon Musk at the helm is always going to be ripe for some volatility based on what he's doing and now his political activity. As soon as Trump got elected, suddenly Musk is there, and there's 31% gain in Tesla just because of Trump and the future belief that there'll be greater deregulation of autonomous vehicles and robots.
Jason.
Yeah.
Excellent.
That is,
I think, unfortunately, we got 1 minute.
Only 1 minute?
1 minute, and then we have 2 questions, and they need to move to some
So you've
other
got somewhere else
classes.
to go to, have you?
Yeah.
Okay, so we won't look at COVID, but that was pretty incredible. So you can buy William Hill dropped 80% because the market thought that no one would ever travel again, and GameStop was also quite incredible. We haven't even got on to the...
We have a question for you.
Yeah, questions.
I have a question, and then you have a question. Where are we standing now with AI, NVIDIA, and other stocks going up the same, right? Is AI, in your view, the same bubble? Is there the same bubble, or is there different? What's your view?
I think with NVIDIA, its share price went up something like 250%, was it, in 2023? And so yeah, I think there's an element of a bubble within the likes of NVIDIA, and undoubtedly the market for semiconductors is increasing massively. But I think with AI, it depends on a company if it's going to benefit from AI or not. And so the likes, and I've always, in my course, oscillate my opinion between the mega caps like Amazon and Apple, and are they overvalued or not? But they've got so much research going into AI and developing humanoid robots. And yes, AI is with us. I think there will be further bubble, further price appreciation. Yes, that will lead to a bubble.
Rupert?
I was just wondering, for final year students like us entering into the finance industry and entering into the real world, what advice would you give us about developing a successful career in wealth management, or something like how you've done?
Well, it's wealth management industry. There's different avenues to. I mean, there's sort of academy programs that wealth managers run. If you have an interest in the markets, it helps because it provides a bit more credibility when speaking to clients, that you can understand the markets and tilt portfolios, and so it's, I think, keep an interest in themes, trends, and it's quite a vague answer, politician's answer, but I'm sure there's different ways to then enter, whether it's through investment banks or some of the asset managers, and then through interviews showing that passion for investing and understanding some of the pitfalls.
Any other questions? Right.
So if anyone wanted to start trading, how would you suggest they start, and do you recommend any resources for someone?
Well, it depends on the trade. There's the day trading, which is dangerous because it's so leveraged. You've got to be really careful. And so when I joined London Academy Trading, they said 90% of people lose 90% of their money in 90 days. And you can understand it because they don't understand how to size a position. And so if it's more traditional trading or investing, it depends if it's trading or investing. So the equity investing course is longer term fundamental analysis and understanding companies' position in the next couple of years. If you're looking to make more money quicker, whether that's an element of a trade, and there are opportunities to trade, so you always see news flow affect prices, and there's always short-term volatility that you can trade, and so it really depends on what kind of strategy you're trying to employ.
Last question.
No, I just wanted to ask you what are the biggest risks in equity investing today? What do you think?
It's on a single stock levels, the likes of Tesla going up 31% just on the basis of Trump being elected, and you've seen that Tesla share price. I think the biggest risk for me would be the escalation in Ukraine, because if Russia, Ukraine have now been allowed to use ballistic missiles into Russia, so we'll see how Russia reacts to that. And as we've seen the impact of wars, if it's a localized war, it doesn't tend to have much impact on the markets, but something that could really involve other companies, then that would be a concern.
Last question.
I don't know if this question is too bullish to ask,
Okay.
but what's the latest trade that you've made?
The latest trade, no, it's still some of the day trading, and so when I day trade, it's trying to be in a trade for 2 minutes, 3 minutes, really that quick.
Okay.
And so that would be.
So what's your favourite pair?
Well, no, this is the currency. This is currencies.
Yes.
This is.
Which
Well, I
one?
don't have a favourite because I'm looking at the chart and then trade on the back of that.
Good. Thank you so much. I think it was very good. A round of applause. Thank you. You learned something for your career.
Slides.
And thank you
This
very
is
much.
Financial crisis.